Hello my fellow investors and welcome back to another episode on finding out 3 companies in each individual sector that might be a pretty good buy. Especially guys, since the market recently has just been completely crashing. We have done this so far for the tech sector, the communications sector, consumer cyclicals, consumer staples, and now we're in the financials sector. And yeah guys, this is going to be very interesting. I'm going to avoid analyzing the banks pretty much because I've done a lot of them already. I want to take a look at these companies over here and see if we can find any that may be of decent price, as well as some of the credit card services that I have yet to do. So with that said, let's get started with the first company, and that is none other than the company American Express, which is a credit card company, guys, similar to that of Visa and MasterCard. However, this one almost has like some kind of cult following to it, mainly because only like I think rich and wealthy people use it, and I'm putting that in air quotes. So this will be fairly interesting. Now coming over here to the calculator, guys, we got the ticker symbol for AXP, market cap of $102.6 billion, the PE of 14.04, and the current share price of $136.81. Now on the 1 year, this is actually down 20.23%, and on the year to date, they're down 18.67%. On the weekly, on the 52-week, you can clearly see that this is definitely towards the 52-week low, reaching a high point of almost $200 and a low of $130.76. So this might actually be a fairly good price to buy this company at. Annual dividends per share of $2.08 ends up being around $1.6 billion being paid out in dividends every single year in regards to the current shares outstanding. And looking further into this dividend, this actually comes out to be 1.52% for an annual dividend yield, which is 52 cents per share, a payout ratio of 19.49%, and a 5-year CAGR of 8.72% with 1 consecutive year of dividend growth. So all of that is looking all good and dandy. However, in regards to the 5-year average free cash flow, after this $1.6 billion is paid, they're still left with $8.3 billion in their average 5-year free cash flow. And as of last year's free cash flow, it is $11.44 billion, which is actually massive. These payout ratios, guys, come out to be 15.89 for the 5-year average and 12% for the last year's free cash flow, meaning that they could 100% afford this dividend as well as increase it in the future. Coming now into some fundamentals, starting of course with a net income 5 years ago of $2.7 billion to 1 year ago of $8 billion, increase of 193%. They did have a dip here 2 years ago, probably because of COVID, so that's perfectly explainable. However, you can clearly see that also from 4 to 3 years ago, they also did a little bit of a dip as well. But nonetheless, it is still an increasing net income, even to last year and probably even today. Coming now into the free cash flow, 5 years ago of $12.4 billion to 1 year ago of $13 billion, small increase of 4% with an average of $9.8 billion. Obviously, the dip happened here 2 years ago because of COVID. However, 4 years ago, they had another dip here going from $12.47 billion 5 years ago to $7.6 billion 4 years ago. Aside from that, guys, even though the trend line is technically going down, it is somewhat remaining stagnant, if not increasing a little bit. Coming now into the revenue, 5 years ago of $33.9 billion to 1 year ago of $43.8 billion, increase of 29.31%. And again, nice steady increase, except for 2 years ago where they went down because of COVID. But aside from that, guys, is looking really steadily increasing. Looking now at the total assets minus liabilities, currently they're at $23.23 billion, up from the past years a significant amount. 5 years ago it was $18.3 billion, and again, pretty consistently increasing overall, except for 1 year ago where they actually dipped down to $22.2 billion. Average total assets is $192.2 billion. Average liabilities is $170.2 billion. Doing this difference, they're left with $22 billion. Looking now at the cash flow minus the liabilities, this currently is at a negative $153.4 billion. However, only as of just 1 year ago is when they're actually trying to increase it back down to zero. But you can see from 5 years ago to 2 years ago, it was consistently increasing at a pretty decent rate. Average cash flow minus the average liabilities, we get negative $158 billion. Coming now into the shares outstanding, one of the most important metrics, because this one tells you whether or not the company is diluting you, as well as that dividend payout ratio as well. Obviously, the more shares outstanding a company has, the worse it is for us, because that means that more dividends have to be paid out. Now, when it comes to this company, guys, 5 years ago of 859 million shares to today of 751 million shares, decrease of more than 12.5% from the 5-year, and then from the previous year to the current year, that is a decrease of 1.31%. Really, really nice. They're buying back shares and giving us, the investor, a bigger piece of the pie, as well as making their dividend more affordable. And lastly, when it comes to the cash and equivalents, they currently hold $25 billion with an average of $27.1 billion. Making some assumptions of low, median, high using revenue growth of 8, 10, and 12% for the low, median, and high assumption, and a projected share buyback of 5, 6, and 7% for the same ones, and keeping the required rate of return the same, guys, at 10%. This puts me between the ranges, not adjusting for debt, of $154 to $179.79. Adjusting for debt, this actually comes up, meaning that they do not have that much debt on hand, which is actually fairly good. It is now $164.76 to $190.56. And then adding a margin of safety of 5, 10, and 15%, this puts me between $140 at the lowest and $181.03 at the highest point. Guys, with the current share price of $136.81, this by all means looks like an all-out buy overall when it comes to this company. Now looking at the annual dividends per share, putting in $5,725, this nets you $87.04 in annual dividends. So unfortunately, it could be higher, but then again, guys, according to discounted free cash flow, it is telling me that it's a very, very good buy today. All in all, American Express, it does have a couple issues here and there when it comes to their profit metrics. However, overall, I think it's still a pretty decent buy as it currently stands. And now with that said, let's head over to the second company, and that is the company Rowe Price. Now guys, this is an investment firm that helps people with personal investing, retirement accounts, and so on. And looking at this company, guys, we got the ticker symbol of TROW, market cap of $22.2 billion with a PE of 9.49 and a current share price of $98.31. Which, looking at this graph, guys, we can see that on the 1 year they are down a whopping 50.2%, and on the year to date they are down 49.48%, pretty much 50% also on the year to date. On the 52-week range, this is a massive range, guys, going from as low as $93.58 to $223.36. As you can clearly see, we are definitely at that 52-week low. So as it currently stands, this might be a pretty decent price to buy it at. They do have an annual dividends of $4.80 per share, which ends up being $1.1 billion being paid out in dividends every single year. Now looking at this dividend further, we can see that this is a yield of 4.88% with a payout ratio of 42.03%, a 5-year CAGR of 15.77 with 35 consecutive growth years, guys. That is absolutely insane when it comes to their dividend metric. Absolutely crazy. Double digits 5-year CAGR and double digits and a dividend aristocrat as well for dividend growth. Now this dividend, after it is paid on the 5-year average free cash flow, unfortunately they're only left with $462.66 million, and as of last year's free cash flow they're left with $2 billion. That's a massive difference, guys. And well, you can clearly see that as well in their payout ratios, which is 70.07% for the 5-year average and 33.72% when it comes to the last year's free cash flow. We need to figure out why this is this high and this last year's free cash flow is not. So let's actually see some of these numbers. Starting, of course, guys, with the net income, we got 5 years ago of $1.5 billion to 1 year ago of $3.1 billion, increase of 106%. And this is looking very consistently, guys. Every single year, nice steady increase. So overall, it's looking really good. And now looking at the free cash flow, guys, this one has the 1 year, 5 years ago, that it's very peculiar, and this is essentially what's skewing the 5-year average free cash flow, as well as my discounted free cash flow. I actually had to tweak it a little bit in order to ignore this 5-year average because it is a massive swing from $43.4 million 5 years ago to 1 year ago of $3.2 billion. That is an increase of 7,303%. with an average of $1.5 billion. So obviously this $1.5 billion is actually being skewed down because of this 5 year ago value. And unfortunately for that reason, this is causing that payout ratio to be that crazy, as well as the discounted free cash flow. Just full disclosure, I did have to change it up a little bit in order to get the values I got. But nonetheless, guys, definitely something to figure out what in the world caused this free cash flow of $43.4 million and and the sudden jump 4 years ago of $1.45 billion. Looking now at the revenue, this is also looking very, very nice. 5 years ago of $4.8 billion to 1 year ago of $7.7 billion, increase of 58%. Assets minus liabilities also looking really good. Currently, they're at $9.7 billion with a nice steady increase within the past 5 years as well. Average assets is around $10 billion. Average liabilities is $1.4 billion. And doing this difference, we get $8.5 billion. Now, looking at the cash flow minus the liabilities, guys, this is looking amazing. Normally, all of these numbers are in the red. However, you can see here, 4 out of these 5 years is actually in the positive by a significant amount, right? As of 1 year ago, it is $957.6 million. The only reason why this one 5 years ago is this low is because their cash flow was just really, really poor. But aside from that, guys, this is looking amazing. Average cash flow minus the average liabilities, we get $286.86 million. Looking now at the shares outstanding, they're also buying back at a pretty good rate, $245.1 million to $225.7 million, decrease of almost 8% on the 5 year and 1.53% on the previous to the current year. And lastly, when it comes to the cash and equivalents, they currently hold $2.1 billion with an average of $1.8 billion. Now making some assumptions of low, median, high using revenue growth, projected share buyback, and the required rate of return, we get some target share prices, guys. I'm going to say for low, median, high revenue growth, I'm going to say 0.2%, 0.7%, and 1.2% for the revenue growth assumptions. And for the predicted share buyback, I'm going to say 2, 4, and 6. And guys, for the target share prices, not adjusting for debt, this becomes $101.35 to $109.38. And then adjusting for debt, it goes up by more than $100 to now $212.26, all the way up to $228.72. Adding a margin of safety of 5, 10, and 15%. This ranges between $180.42 to $217.28. So guys, as you can clearly see here, in pretty much all scenarios, this is looking like an all-out buy with a current share price of $98.31. Looking now further into this dividend, putting in $5,725, this nets you guys $279.54 in annual dividends, so not too shabby. Overall, Rowe Price, the main issue that I see with it is that 1 year's free cash flow, which happened 5 years ago. And aside from that, guys, everything else is looking amazing. So that does it for the second one. And now for the last one, it is none other than the company Lowe's Corporation. And no, guys, I am not referring to Lowe's, the consumer retail one. I'm talking about Lowe's, L-O-E-W-S, which this company provides insurances for casualties. And looking at this company further, guys, we can see that they have a ticker symbol of L, market cap of $12.77 billion, and a PE of 12.31, and a current share price of $53 on the dot. Coming now to their graph, we can see that on the 1 year they are down 7.16%, and on the year to date they're down 8.78%. 52-week ranges is between $49.37 to $68.20. Not at the 52-week low, however, it is definitely closer to the lower end side. So with a $53 share price and a PE of 12.31, this may actually be fairly interesting. So we're going to be using book value to figure out what is the correct price to buy this company at. Now they do have an annual dividends per share of 25 cents, which based off of their current shares outstanding pays out $60.55 million every single year. And this translates to a payout ratio of unfortunately unknown and a 0% 5-year CAGR and a 0 dividend growth. However, looking at the dividend history, guys, we can see that the reason why this is the case is not because they haven't been issuing it, it's just that they haven't just increased it. In fact, they've kept it the same at 6 cents for the past however many years. Essentially since 2006 they kept it at 6 cents per share. So this may not be a case that it may be good for investing in it for dividend growth, but at least they are very, very consistent with it. So even though this may not be a pretty good company to buy for its dividend growth, they have been very, very consistent with this dividend payment nonetheless. Coming now into the fundamentals, starting of course with the net income 5 years ago of $1.2 billion to today of $1.1 billion. That is a decrease of unfortunately 7%. However, guys, take a look at this. 2 years ago, they actually went in the negative. And the reason for this is actually very, very simple. They have insurances for casualties, meaning that when everybody's stuck at home, there's not going to be any casualties. So that pretty much explains this issue. But aside from that, even though on the 5-year they are going down, this year, guys, isn't over yet, so they might actually get higher than that of their 5-year ago value. Coming now into the revenue, we got 5 years ago of 13.7 billion to today of 13.8 billion. That is an increase of 1%. We also see that dip that happened 2 years ago, but again, perfectly understandable because of COVID. And overall, it is still an increase nonetheless on the 5-year of around 1%. Coming now into the shares outstanding, this is looking absolutely gorgeous, guys. 5 years ago of 332.1 million to today of 242.2 million, decrease on the 5-year of 27.07%. And from the previous year to the current year, there's another decrease of 2.5%. Coming now to the total assets and total liabilities, unfortunately, this one's also coming down, and this is not one that you want it to come down. Currently, they're at $16.2 billion, and 5 years ago, guys, they were at $24.6 billion. Average total assets is 79.8 billion. Average liabilities is 59.4 billion. Doing this difference, we get around $20.4 billion. And now when it comes to valuation using book value, currently they are valued at $62.90, up 9% on the 5-year. And looking at the tangible book value, they are valued at $61.47, up 14% on the 5-year. So looking at the price divided by the current book value and the price divided by the current tangible book value, we get the ratios of 0.84 and 0.86 respectively. Remember, anything under 1, guys, it is considered undervalued. So as it currently stands, this company is very much undervalued based off of the book value per share and tangible book value per share, with a current share price of $53. And on top of that, guys, when it comes to a dividend payment, as I showed all of you guys, this company hasn't increased their dividends since 2006. However, they are very consistent with it, putting in $5,725. This nets you $27 in annual dividends per share. Lowe's Corporation may not be a company that you buy for its dividend, but it may have a lot of upside when it comes to buying it for a capital gains kind of appreciation. And that pretty much does it, guys, for the financial sector and this video. Obviously, remember, none of this was financial advice, so please do not follow exactly what I'm saying. If you want to invest in any of these companies or any ones that you may want to invest in, guys, please do your own research. Of course, you guys can have my calculators. They're all for free. The link is in the description below, so please have them and make your own assumptions because none of this is financial advice. But anyways, that pretty much does it for this video. If you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out and be on the lookout for the next video on this mini series. We're going to take a look at the healthcare sector. Probably going to skip a lot of the drug manufacturers because they're very big, but we are going to take a look at all these other ones that may be interesting. So with that said, peace out, and I will see you all next time.